this is Robert with Real Property Management, Indianapolis Metro. Today we're going to talk a little bit about real estate investing, why choose real estate investing and other different alternatives out there, as well as, what kind of markets you want to get into. Obviously, every different market in real estate, it performs differently, has different economic issues. Some markets are more stable, higher rates of return, more risk factors, and specifically we'll be talking about Indianapolis today. I have investors all over the world that invest in Indianapolis, in big markets in the U.S. like Texas, California, New York, D.C., investing in Indianapolis. All over the world, like Israel, South Korea, Singapore. It's just anywhere in the world, people want to put their money somewhere to get a higher rate of return with a lower rate of risk. Right now, we're seeing changes in the stock market on an economic level, on a global level, that is affecting the local economy. And personally, I would be scared to be in the stock market. Whereas real estate, the swings are much more mild, not usually as rapid, or the downside doesn't fall as fast as Wall Street does. Yes, we did have a major fall back 2007, 2008, and even then it took a couple years for it to crash, whereas Wall Street can crash overnight. That was an overvaluation. Probably won't happen again for a long time if it does happen again. But so we'll talk about Indianapolis. First question is, why Indianapolis? In any type of investing, you have to understand the mindset of the investor. The sophisticated investor looks at risk as much as reward, sometimes more than reward, because they realize that if the risk isn't taken into account, that reward can be wiped out in a single moment. That's why most day traders end up broke. That's why, the most sophisticated investors buy options to hedge their position so that if things do take a rapid turn, they're in a position to capture a lot of the profits that they've made. It's no different in real estate investment. What kind of risks do you see? You see risks such as, appreciation and depreciation, global or local markets like unemployment, education, the types of people, the growth of the population, the types of homes that are available, and the restructuring of the neighborhoods, redevelopment of the neighborhoods, the historic stability of a specific market. There's been various reports, all from the Wall Street Journal, from Business Week, Forbes, Money Magazine, CNN Money, online syndications from Zillow, from Bigger Pockets, and everybody says very similar things, that the most affordable cities and growing populations are the places you want to invest. Typically, the most common places that are listed are going to be in the Midwest or in the South. The Midwest markets, there's some big ones. Indianapolis is not the only place. There's Kansas City, there is Memphis, there's Indianapolis, there is Cleveland. It's a variety of places. Indianapolis, if you are a real estate investor and you live in San Diego, you know that you can't not get a property for, less than probably $200,000, $300,000, anything viable. In Indianapolis, you can get into the investing game for $50,000, a lot of times even less. The average, or the median Indianapolis home is actually about $70,000. Indianapolis is rated as one of the lowest cost of living to live in, but they have a decent income range. There's economic stability. We were only affected, housing was only affected with a 7% decline during the destabilization and the real estate bubble 7 or 8 years ago. There were markets in the U.S. that fell as much as 50%. Can you imagine having a house worth $700,000 and a year later it's worth $350,000? That's amazing. And we did have houses drop. We had houses that dropped 20%, 25% probably, but it wasn't nearly as destabilized as a lot of your other markets, a lot of your larger markets. As a whole, we've seen that Indianapolis holds its stability anytime there's economic recession better than most other markets. Right now, Indianapolis is being listed as a big place for tech jobs. A lot of developments in some of the suburban areas. There have been headquarters stationed in Indianapolis for technical places, and we're seeing this more and more. Fisher's just started an incubation just for tech professionals. It's been listed as the Silicon Valley of the Midwest. We have a low unemployment, one of the lowest unemployments in the Midwest. Obviously, the ability to make money, to have stable property values, to have good, solid renters. To evaluate risk, you have to evaluate the tenant demographic. Years ago, rental properties, 20, 30, 40 years ago, rental properties went to people who couldn't afford to buy, who lived very unstable lifestyles or were in between very tough spots in life. We didn't have a lot of professionals renting homes, but our entire lifestyle's changing. A lot of young professionals don't want to own. They don't want a 20 or 30 year commitment. They don't want to be locked into a single house or a single city. They want to be able to upgrade, downgrade, get something low maintenance if necessary, and live on a year by year basis. They're the same people that drive a new car every 3 years, get a new cell phone every 2 years, that lease cars. They don't worry about the underlying asset as much as flexibility and convenience is important to them. So the tenant demographic, when you have young professionals renting houses, obviously you're going to have a nicer tenant demographic, which is once again going to reduce those risks. What are other kinds of risks in real estate investment? You have everything from evictions. Everybody's heard the horror stories of evictions, damages, and those are probably the two worst ones. The list goes on and on. One thing that's nice about Indianapolis, and one of my California investors told me this just probably about 3 or 4 months ago, the main reason they specialize in the cities they do, Indianapolis being one of the top ones that they're in, is the landlord-tenant laws. See, some of your markets, you can have a tenant you can have a squatter, you can have a tenant that's not paying rent, you can have abandoned property, and you cannot legally take possession of that without going through the eviction process, which could take 6 months in some of those markets. In Indianapolis, we can typically turn a house on an eviction in about 3 weeks. Now, at that point, they're also a couple weeks late. So we're looking at about 5 to 6 weeks on actually getting a house vacant, getting it prepped to bring it back to the market. Speaking of landlord-tenant laws, that is one of the big things that there's several protections in Indianapolis that the legal system awards landlords. Evictions being one of them. Being able to recoup damages beyond the security deposit. How that security deposit is distributed. Things like how long a lease can be, how often you can do rental increases, and caps on rental increases in some markets. It's not here in Indianapolis. Obviously, if you're raising the rent 100% every year, you're not going to be successful. But having the ability to raise the rent, along with the market and continue that return on investment, that cash on cash return, is super important. So these big markets that have a lot of tenant protections, and it's not that Indianapolis doesn't protect the tenants, but they understand the importance of making sure that the landlords are protected, that they have the ability to allow their investment vehicle to perform at a high rate, at a high level. So that draws landlords or real estate investors into the Indianapolis marketplace. So, to answer the question, why Indianapolis? The reason is low risk. It's inexpensive. The returns are good. It's very, very common for me to see anywhere from 9 to 15% annual returns for our investors, and that's not just 1 year. It's year after year after year. They're not getting wiped out. There's a good way of screening from the great tenant pool that's here to reduce the risk of people who would damage your property or not be able to pay rent or not desire to pay rent. The ability to recoup damages beyond the security deposit. The ability to get people out and get the house to reperform after you have one of those hurdles, like somebody that's not paying, or a squatter that's moved into a vacant property, or people that's just moved out and you don't have keys to, and you're not sure about the legal basis of being able to regain possession of that house. So I look forward to continuing this series with more information about investing in general, real estate investing, real property management, buy and hold strategies, rental properties. But until then, I look forward to seeing you next time. I'm Robert with Real Property Management Indianapolis Metro, and Real Property Management is the national trusted leader in property management and leasing for over 25 years. Thank you very much.